Welcome to the Concierge CPA. I'm Jackie Meyer, founder of TaxPlanIQ software. This is a podcast for accounting firm owners and influencers who are pursuing world-class service. Let's go, y'all. Hey there, I'm Dr. Jackie Meyer, CPA, and welcome to the Concierge CPA podcast. Before we dive in, here's something exciting. TaxPlanIQ users are saving their clients an average of $40,000 in taxes per taxpayer while selling large tax plans. TaxPlanIQ is the ultimate resource for tax advisors. With nearly 500 firms on board, we're helping advisors build skills, grow confidence, and connect with a vibrant community. Want to learn more? Visit taxplaniq.com/podcast for exclusive discounts, resources, and other things mentioned in this episode. Now, let's jump in. Welcome. Today's episode is for every tax advisor who's ready to move beyond tax prep and into real tax strategies. If you've ever looked at strategies like captive insurance and thought, that sounds incredible, but it's kind of intimidating, then this episode is for you. We're going to get real and practical. I get it. It's one of those tools everyone talks about towards year end, but few actually use it because of a fear. What if I explain it wrong? What if the IRS questions this? What if it's too complex for my clients? And those are all very valid concerns and exactly why I wanted to have this conversation. So by the end of today's episode, you'll know how to identify a client who's a strong candidate for a captive insurance strategy, what red flags to avoid, and how to explain it simply and confidently so your clients can actually get it. And to help me break that down, I've invited someone who knows this inside and out. We met several years ago. Vardan Pogosian is a user of TaxPlanIQ, a former IRS agent turned proactive tax strategist who helps advisors implement captives the right way, compliant, strategic, and practical. So let's jump in. Vardan, welcome to the show.
Thank you. Thanks for having me.
Of course. So let's keep this real practical. One clear definition, one real client example, and then we'll kind of hit a few quick myths that happen, things that people tend to assume about the strategy, and exact steps advisors can take to start real conversations. So starting with the basics, what exactly is a captive insurance company in plain English?
Mm-hmm. Well, every business has risks. So IRS Code Section 831B allows every business to insure their risks. So it's a risk-first strategy. So before we talk about tax, savings and in how it works for taxes, I'd like to always emphasize that this is a business risk strategy first. So every business has risks, and under IRS Code Section 831B, the businesses can self-insure their risks. They can open their own, pretty much, insurance company. So it's formed and acts as an insurance company. So, but the main client is your business. So ABC Corp sets up XYZ captive and contributes premiums to that captive, again, assuming they have business risks, which we can talk about in more detail later, and pays premium. Captive insurance takes it tax-free, believe it or not. In 2025, the limit is about 2.9 million. Any business can pay up to that much premiums to their captive. The captive will take it tax-free until the captive insurance company is dissolved. In that case, they'll pay, capital gain taxes.
All right, awesome. Yeah. So you're building your own private insurance company for the risks that maybe a commercial policy ignores. What are the most common kind of risks, or is it always customized depending on the person's industry or status?
It's pretty much customized, but there is one risk that pretty much, I would say probably 90% of businesses have now after pandemic is business interruption. Good luck going to Allstate or State Farm asking to insure next pandemic. Not going to happen. They're going to laugh at you and it's never happening. So business interruption post-pandemic, it's pretty much opened the door to any business. Before pandemic, businesses had a hard time qualifying for captive because not every business has inventory, not every business may had like cybersecurity risks and things like that. But business interruption is big now.
Okay, yeah. That's definitely when it became really peak on my radar, was post-COVID, and it seemed like it made a lot of sense for a lot of people. Even the government was essentially helping us out with different ways of reimbursing us for those things. So
Definitely.
there's a lot of fears I hear around this. Pre our conversation, I was looking at the Facebook group, accounting from influencers. We're both members. I'm the moderator. People ask some great questions there about what is the strategy, who's using it, is it practical? So I tend to hear three main fears: sounding unsure in front of clients for the tax advisor, preparer, accountant, right? Getting on the IRS's radar and like kind of what the audit risk is when you do this strategy, and then wasting time if the numbers just don't pencil out for somebody. So, can we talk through those? And then, of course, if there's any others that you tend to hear that you think our viewers would really get help from as well, that would be great. So, how do you help uh, our viewer and listener sound more sure in front of the clients?
Yeah, I work with many CPA firms, and I kind of pre-train them how to vet the client. They don't have to know captive in and out. Oh, it's a very simple process to pre-qualify a client. First,
Mhm.
does the client have business risks, like minimal? And we also push the CPAs and advisors to vet the client on a revenue basis as well. So we want to see, 3 to 4 million in gross revenues. We can work with less. We've worked with clients who had 1.5, 2 million. The ROI is not that great when they have lower revenue thresholds. We also want the businesses to be profitable. So if the business is a low margin business, right? Yeah, they may have grossed 5 million, but they're showing 120K of net income. That's probably not going to be a good fit because we don't want to create a loss with this strategy. At least I don't.
Mhm.
That's my approach. So we want to have a profitable business. So the CPAs and advisors can look and see, does this client have the revenues? Is it a profitable business? And maybe some of those profits we can divert to captive structure legally. So that's our approach. So CPAs can look at revenues and profits, and if it fits that criteria, they can reach out to me. And I'm not just a middleman between SRA and the CPA community. I do the legwork. I do actual work. I pre-qualify the client. We look at clients' financials. We look at their history of claims and risks. Uh, the CPAs don't have to know that. They can
Mhm.
simply look at revenues and run it by me. We'll take a look at it and see if it's a good fit for the client. And to address your other concern that you've seen is it listed transaction? That's $1 million question that
Yeah.
CPAs always ask, right? Is it abusive? I don't want to bore the community now with the history of captive. Like I audited captives at IRS. So I was an IRS revenue agent for about 9 years, and I've done close to 2 dozen IRS captives. I've been
Mm.
involved in close to 2 dozen IRS captives, and it's a strategy that has been abused in the past. There is no hiding. I mean, it has been abused. There were a lot
Mhm.
of bad apples in the industry. The industry has cleaned itself up lately, and I don't see those abusive transactions as much now. And IRS currently has a legislation in Congress, and we're operating as if that legislation passed. It's proposed regulation. And under that proposed regulation, if the client does not take a loan from captive and the loss ratio is below 30%, it's not a listed transaction. So
Okay.
it's a good news. So if your client participates in a captive and does not take a loan out, it's not a listed transaction. 30% loss ratio is very, I mean, it's a secondary kind of, it's not a big deal. The biggest thing is the loan from the cap.
Okay, got it. No, that's really, really helpful. So going back for a second here, if I'm looking at my client's prior year 1040, which is a great identifier of what their
Mhm.
net income from the business looked like, what does their gross income look like? Um, I believe we discussed about 150K plus in premiums per year for
Mhm.
how many years is kind of the minimum threshold. So think about it, y'all. This is if we're going to recommend 150K premium at a minimum, they need to be netting at least 150K, if not double that, for them to have the
Yeah.
cash flow to put money into this premium because the premium they deduct. That's where it all comes together, right? They deduct the premium on their business side. The insurance company does not recognize it as income based on insurance law, right? And
Hmm.
that's how you get that the leverage,
Hmm.
so to speak, from the tax code.
Yeah.
So do you think I explained that well in regards to like what you would look for on someone's 1040?
Yeah, 1040 it could be a good start, but you have to go up to the business level to make the final determination. So 1040 is a good starting point where like, okay, is this client profitable, right? You may have other companies. 1040 is a good place. Some clients have multiple entities, and we can insure from those multiple entities. So multiple entities on 1040 is a trigger, and the profits, right? Like you nailed it. 150K minimum premiums. If your AGI is 150K, that's probably not a good fit. So then we
Right.
go up to we want to see 2-3 times more profits. I mean, 2-3 times of the premiums, minimum premiums. So 450, 600, 700. These are like lower end spectrum. This is the lower end spectrum of things. But then we go up to the business level. And then at the business level, we'll look at the revenues. If there are multiple entities, we'll analyze all entities, take a look, analyze risk. Each entity might have different risks, and we can assess that. So 1040 is a good start, and then we roll up to the business and analyze further.
Okay, perfect. And how many years do they need to plan to dedicate these premiums for? And is it one of those things where it's like it has to be for 10 years for this exact amount, or is there flexibility?
Now, there's flexibility. You can usually we tell clients have a 5-year outlook. It doesn't mean they're required to keep it for 5 years, but
Hmm.
I have a spreadsheet where we show like the power of tax deferral over a 5-year period with the captive insurance strategy, and using like very conservative 8%, 7% return on investment. The clients can visually see the power of captive. If they contribute to captive and they exit at the end of 5 years or 6 year, they exit. And the beauty of that is you grow your money on tax deferred basis, pretty much tax free. The captive does pay tax on gains it earns inside the captive. So the gains are not tax deferred. You pay tax each year on the gains. But then at
Hmm.
the exit, you pay capital gain. So there is an arbitrage, permanent tax savings between money coming in at 50% in California here. Uh, you know, Clients pay 50% tax, and at exit they pay capital gains, which the maximum is 36, 37% capital gains tax in California. So that's basically there's a permanent tax savings plus the power of investing on tax deferred basis. And we'd like to tell clients have a 5-year outlook. But
Okay.
again, they can, Jackie, they can dissolve it next year. I mean, they can
Okay.
form it. Something can happen. People ask all the time, oh, what if something happens? What if this? What if that? Sure, you can dissolve
Right.
at any time. You're going to pay capital gains tax. You won't have a lot of wealth created in 1 year through tax deferral, but
Hmm.
you can exit at any time. There is no restrictions. There is no penalties in the tax code to dissolve a captive. Yeah, unless you view
Okay.
the capital gain
Yeah.
tax as a penalty.
Let's walk through a specific kind of case study or example. But first, can you kind of explain what's this idea of like micro captives and why do they get such a bad rap with listed transactions or the IRS in general?
Yeah, like I said, there is a history of it. I mean, back in the 80s, Congress has passed this law. It's been on books for several decades. It's in the tax code. I like strategies that are explicitly stated in the tax code. There are strategies where it's interpreted from the tax code. 831B is as clear as day. It's in the tax code. So to me, all the abusive history of captive, and this is very important for the CPA community to hear. If something is not done right, it can be done right. It's in the tax code. I mean, it's simply if you take and use what IRS has laid out, they did say what they're looking for. They're looking for real insurable risks. They're looking for risk distribution. In the past, it's been abused, and people would insure zombie apocalypse. I'm not kidding. Yeah, I mean, back in 2010 and 11, yeah, when I was at IRS at that time, I mean, you wouldn't believe the stories you would hear. You'd go like, this can't be real. People were insuring crazy risks that can't possibly exist, Armageddon and things like that. So, it's now we're in a different place. The industry is going in the right direction. Some tax court cases have shed some better light to captive promoters. And I don't know if I diverted from your question a lot, but yeah, the history of captives being abused is there. It's real, but it can be done the right way.
Okay, fair enough. Hey, it's Dr. Jackie. Are you enjoying today's episode? If you are, here's how you can support the podcast. Like, share, and subscribe to the Concierge CPA podcast to help us reach even more listeners. Continue the discussion and connect with other accounting professionals in the Accounting Firm Influencers Facebook group or follow me on LinkedIn. Thanks for listening, and now let's get back to the show. Let's take kind of a recent client example where you were able to really help give them peace of mind, so to speak, around giving them the insurance option that they probably couldn't get covered elsewhere. But also, what did the initial deduction look like each year with the premiums paid? And then what happens, let's say 10 years down the line, whenever they liquidate that asset and it turns into the capital gain. Can we walk through some
Sure.
math?
Definitely. I have many examples, but I'll mention one. I have a client who's a doctor. He has a very successful healthcare practice, and he has even more successful supplement business, where through his practice and also on wholesale basis, he sells supplements, peptides, make you younger, kind of new trend peptides. There's a lot of, hype around that. So he's very successful with marketing and selling those. So he has a ton of risks, right, in his traditional practice and his supplement business. So we've designed a captive insurance company and a plan and premium plan for him to pay. He's paying, north of $1 million in premiums, way north of $1 million in premiums to his captive. And recently, Jackie, he has a warehouse in Arizona, and the AC unit, bit the dust and was not working. So he had, on cost basis, close to $300,000 worth of supplements go bad due to this AC unit not working. So he had texts, email messages to management company. We documented all that, and we submitted to SRA. I helped him submit to SRA a claim. So he has real, insurance company that works for him, and SRA has a claim department. It took about 3-4 weeks. The claim was approved because we had all the documents, and we have proven the loss. He had invoices and inventory records for all the supplements that went bad. So it acts as a real insurance company with real risks. We have claims just like any other client insurance company relationship. You have a relationship with your captive. It just happens to hold your money there on tax-deferred basis. That's a secondary benefit. Primary benefit, we always tell clients, is a business risk first strategy. So just to give you the scenario, and he's taking deductions his third year. He has over 5 million in his captive there. He has a very good financial advisor investing inside the captive. He's paying tax on investment gains. I think he's doing 11%, I think, on his investments inside the captive. That 11% gain is taxable, 21% where in state of Oklahoma, the captive SRA sets up in state of Oklahoma, and there's only 21% C Corp tax that the gains are attributable to. And once he exits one day, if he decides to, call it a day and exit his captive, he'll pay on his assets inside the captive capital gains tax. That's tremendous tax savings for him.
For sure. Yeah.
So if he does this for 5 years, like he's gonna have close to 7-8 million, probably close to 10 million if he continues to do well with his investments, and he'll pay, around 3 million in taxes, and save himself just on the arbitrage 2 million plus the power of tax deferral on investments. So
yeah, that's amazing. So let's just walk through that one more time. So let's pretend it's someone's putting $1 million exactly in premium in each year. So that's $1 million deduction. If they're probably in the top marginal tax rate. Let's just use federal, not even add state into the mix, right? So let's use 37%. So that's $370K taxes per year they're saving, which over a 10-year period would add up to almost $4 million.
Yep.
So they've saved $4 million. Then you've got your deferral until you liquidate the insurance company later down the road. And when you liquidate, the arbitrage is on that cap gains rate. Well, let's use 20% cap gains rate as worst case scenario here. That would mean on $10 million that has been transferred into that company, again, not even counting the growth that happens within it, that would be about $2 million of cap gains. So your arbitrage there was almost $2 million after that 10-year period. Wow. That's amazing.
You nailed it. Yeah. And it's more because of the, investments.
Yeah. Very
because
cool.
You're growing that money, and you're growing also on the future. You're growing on all of the assets, including what you're going to pay to the IRS one day in capital gain. So that money gives you, returns. So, and it's a beautiful structure. And again, we do a lot of due diligence. It's not for everyone, but the pandemic has opened the door for a lot of businesses to participate in the structure.
Yeah, it's all about it being real insurance, right? Like you said, real insurance, risk transfer, risk distribution, and proper documentation. And that's what you help them with. Okay, so on that note, we got to wrap up. But I wanted to kind of run through very quickly a few myths, and you can tell me if they're true or false about captives. How does that sound?
Sounds good.
Okay. Captives are illegal tax shelters. True or false?
Of course, false. It's legal. There is a code section. It's not a tax shelter if it's done correctly.
Okay. You can insure, true or false, you can insure bad vibes on a slow Tuesday.
Nope. Not gonna work. I mean, it's nice try, but no. That would be awesome, huh?
Yeah. True or false? So the smartest entrepreneurs set their premiums at exactly that cap. What was it? 2.something million each year?
Yeah, 2.9.
Okay.
No, I mean, it's false. I mean, you shouldn't do that. I mean,
yeah.
You shouldn't be doing that. Yeah. You shouldn't have a number in mind, and that's not how we work. We look at the risks. We'll look at, revenues and all that stuff, and wherever we land, we land.
For sure. And then last one, true or false, Captives, you can just set it and forget it. You don't have to worry about any annual compliance or anything like that.
No, it's false. Captive files a return, and
Yep.
SRA has partnered up with a couple of CPA firms they work with. They'll take care of the captive, and that's important for the community also to know that they will not be filing the return for captive. SRA is handling it. So the maintenance fee that the client pays to SRA includes the tax return preparation. So that's that's a lot of concern for a lot of CPAs. Am I going to be filing the captive return? They're not.
Yeah. Okay. And what's the deadline for this? Is it 12/31 each year? And so we want to encourage advisors and their clients to start looking at it earlier than that, right? Because we don't want some mad rush during
Yep,
Christmas. Yeah.
true. Now is a good time. There's still time for 2025 to set up a captive for your client. So if anybody has a client they think is a fit, they can reach out to me or to you guys, and we can see if we can help. Uh, Usually takes about 2 weeks to set up a captive, 2-3 weeks. SRA is awesome. Sometimes they accommodate, but we don't want to be in a situation where it's December 19 and we're trying to set up a captive. That's a lot of pressure on everybody. So bring in the client as soon as possible. We start setting up captives in summer sometimes. I do a lot of presentations and outreach to CPAs, and we have clients sometimes in July and August. They come in. It's more time to do diligence and quality work. So
Mm-hmm. Okay, cool. And what would be an easy way that you would recommend for the practitioner to reach out and broach this topic with a customer? Low risk, like feel like they don't have all the pressure on the world on their shoulders. Is it as simple as just like, hey, have you had any like huge out of pocket costs in the last few years that your insurance policies haven't covered? And of course, they qualify because they're making a lot of net taxable income in their business. And then that kind of opens the discussion, or is there a different perspective that you would use?
yeah, I mean CPAs know their clients well. So for a lot of CPAs do year-end meetings with their clients to adjust the Q4 payments. I always tell CPAs that should be your tax planning meeting, right? Yeah, you can adjust Q4, but it's a great time to sit down, look at year-to-date P&L, look at
Hmm.
profits, project kind of last 2 months, and see, do they have revenue? You already know the client's business. Chances are business interruption policy, IRS audit policy, key employee policy might be a fit, right? So we can ensure if your key employee leaves and your business suffers, we can have that coverage as part of a captive, premium coverages. So it's there's a lot of opportunities for a lot of businesses to do that. So we encourage CPAs to be proactive, especially around this time of the year.
Yeah. Okay, awesome. Well, in TaxPlanIQ, we do have full initial kind of setup checklists and then recurring checklists for utilizing a strategy. Of course, you can lean on our preferred vendors to help you consult and layer in that extra help. But I'm going to do something new. If anyone that's watching or listening wants that exact checklist out of TaxPlanIQ, or potentially just a quick script of how to start the conversation with your clients, DM me on LinkedIn, Dr. Jackie Meyer CPA, and I'd be happy to shoot it over to you. No risk at all. I hope that will help equip more people to feel more confident there. And then, of course, if they want to reach out to you to get help, what's the best way to do that?
Well, I'm in the preferred vendor area of captive, so they can just log into their tax planning IQ. My contact information is there. I was about to also put my calendar link. I'm going to reach out to your staff maybe to see if we can have a calendar link there too. If not, my email is there, my phone number, company name, everything is there. Feel free to email me or call our office, and we can set up a meeting and discuss, you know, if your client is a fit. Once you do one or two CPAs, kind of get into a rhythm and they already know, like, it's the first one is difficult. After that, it'll be a smooth ride for
Okay.
CPAs.
Awesome. Yeah. So if someone wants to reach out directly, maybe they're not yet a TaxPlanIQ user and they have some questions, should they go through your website?
Yeah, website. There's a contact, through my website.
And what is
Vardan at
the exact website address if someone's driving and we want to throw it out there?
PogosianTP.com, Pogosian, TP, T is tax, P is planning.com.
Beautiful. Okay. Well, on that note, I really appreciate your time today, giving us the real deal on what's going on with captives. What better way to do it than someone with so much experience at the IRS? So thank you for that. Any parting thoughts? Is there anything else that we didn't say that you're like, oh, I got to get this in front of them? Or do you feel like we've equipped and empowered our professionals well here?
I think we did good. One last, sentence I may want to throw is AI is coming. So it's going to change our profession in a profound way. So we have to shift from being, compliance only to more advisory and planning, and either doing it directly in our practices or maybe outsourcing advisory services to someone else. It's still a solution. A lot of my clients that I help, and they came from CPAs, they were thanking their CPA first for referring them to me. So at the end of the day, you're still a hero. Just be more proactive is my parting message. So.
Yeah. I love that. You can't say that enough for sure. So thanks again, Vardan. Really appreciate it. And thanks everybody for watching, listening today. Y'all have a wonderful day. Take care. I appreciate you listening all the way to the end. It truly means a lot. As a thank you, I'd love to give you a free gift, my value pricing calculator and proposal workbook. This tool has helped tax advisors create 8-figure tax plans and save over $1 billion for their clients. You can now download it at TaxPlanIQ.com/ROI-method. Thank you for being part of this journey, and I'll see you next time on the Concierge CPA podcast. Take care, y'all. Thank you for listening to the Concierge CPA, hosted by TaxPlanIQ. We believe that every person has a unique message that can positively impact the world. If you are a successful accounting firm owner or influencer who would like to be on this program, please visit JackieMeyerCPA.com, JackieMeyerCPA.com to apply. Please share this on social media and rate us so we can continue our good work. Join our Facebook group called Accounting Firm Influencers, or connect with me on most platforms under Jackie Meyer CPA. Thanks for being accountable to transforming our industry today.